So I've been a sort of fund manager, and it's only in last 3-4 months I've done the rounds of distribution and how financial products are sold. Frankly, fund managers and CIOs actually don't walk out of their rooms and don't realize how difficult is it. It's only now that I'm beginning to understand that it's a fairly difficult job. So uh, what I'm going to share with you is, don't think of it as a guru gyan, because I'm going to talk about your stuff. So think of it as an analyst, an outsider who sort of is looking at you, watching, as to what sort of all sorts of people on the distribution side and advising side are doing, and what are my learnings from having observed lots of distributors doing lots of things, not just in India, but also having read some stuff on how distribution evolved in last 40-50 years in US and Canada more specifically. My credentials are, of course, is that I understand that I want to do distribution now for my business, and more importantly, I'm also a decent forecaster. So so I'm sort of making a tall claim here, but I've been a decent forecaster in markets, and to that extent, you may want to give some credence to what I would say. Not much though. So I kind of think of distribution business. I disaggregate into three parts. I think distribution does advice, distribution does transaction and service, and distribution provides access. This is how I think. Uh, he's only yawning, so it's very not interesting. It's okay. We'll get there to a more interesting part. But I kind of think that when I see distribution, as I said, these are the three sort of component. In my mind, I disaggregated them. Now, what I'll try and take you through is to how I think these three important pieces of distribution are seen by you, and how valuable they are from an analyst standpoint. If I were to value your business, through some framework, DCF or otherwise. So first part of course, distribution is advice. I think everyone kind of thinks that distribution business or distribution of financial product is mostly advice. And I think it's a little bit of a misnomer. Advice generally tends to be an intangible commodity. It can be, it's basically about knowledge and forecasting. Basically, knowing what you're advising for the underlying product, knowing your customer, knowing all sorts of sort of market dynamic, that bit of a knowledge, try and understand that, given how world is evolving in this information age, I think the knowledge, while it's an enabler and very important, the value that one would provide to knowledge, if I were an analyst and you were selling only knowledge, the value is actually very, very low, because it's sort of pretty much free now. So knowledge is sort of bundled with something else. Otherwise, knowledge in itself does not sell well. Okay, really can't price. So in a sense, first principles, I think distribution is lot less about knowledge in terms of valuations now. Second part of distribution is, of course, forecasting, which is how markets will do their well, how certain fund managers will do, what would perform. That bit is actually a very difficult thing to assess. Because not because you're not any good in forecasting which fund manager would do better or which market would better. It's just that people don't want to pay for what do you call it, forecasting, because the underlying bias of most people is that forecasting is so difficult that unless you're a guru, one won't pay for it. So my sense is that the advice as such actually tends to become too monopolistic. It's very, very difficult to have too many people. If you are from Lucknow or Udaipur, not many people would gain that guru characteristic. And everyone thinks that, if I want to hear an advice, I would rather go to the best, go to the CNBC, go to the good guy there. So for a large community to gain that characteristic of, guru is very difficult. So in general, what I'm trying to tell is that even though most of you think, and if you're thinking of your business sort of as a long term, advice, which right now, as it appears to me for most people, appears to be a dominant part of what you do, I think has to reduce in terms of at least time and energy allocation, because there, to building a moat is very, very difficult. Finally, a small point that Indians actually surprisingly don't pay for advice. No, that's not true globally. So even let's say if you're a spiritual guru, you actually have to sell toothpaste and something or other, to actually sell your advice. He's actually, so if you are in US, I went to Jordan Peterson's, who's actually a guru in Canada, and you pay $100 to get in and hear him in a conference. No one in India would pay even 200 rupees to a monk, who is talking about, how to improve your life, right? So he actually has to sell something else. So in general, like CNBC and ET Nows sell a lot of advice, but they sell alongside something or other, fans or ACs, right? So advice in India, people don't pay for some odd reason. That's not true in West. Advice is an important commodity. It's not, but it's not so in India. So to that extent, you will have to pivot away from this. The key message I want you to sort of know this, that difficult for you to actually price advice well and make money off it. Okay. Then the second part, of course, you understand transaction and service is a stepping stone to build relationship. Most people are best served to actually focus on transaction and service. The problem of transaction, sort of, it is tangible, and therefore you can differentiate yourself vis-a-vis others. But sort of what I realize, of course, observing people, is that it is not an operating leverage business, and therefore if I were to sort of price transaction and service of yours, I wouldn't give too much, P multiple, so to say, because I kind of think that it doesn't have operating leverage. You ought to be, I mean, it's a man-hour intensive job, and unless if you're enabling it with tech, and that's also, then that becomes a very, very capital heavy business. So while it is an important for a sort of a small business building in financial distribution, but my sense is that it is not very, very sort of operating leverage business, so to say. Operating leverage means, you really can't sort of, just because you are good at service, you cannot sort of scale your business as rapidly. It can happen, let's say, in aircraft business, it can happen in a lot of service businesses, but this is a very, very man-hour intensive business, and therefore low on operating leverage. Finally, sort of, I think, and lot of people sort of don't think that excess is such an important thing. But please understand that if, go back to the original point, that, distribution, your business is mostly about, as I said, transactions and service, advice, and then this is the third part, which is excess. I don't think people sort of focus too much of it. Excess essentially means what? Excess is mostly about sort of having an access to a certain product or a certain fund measures that, in your community, let's say if you come from Cochin or let's say Kandivali, not many people have an access to that. If you have that, it's very, very likely that it will become a moat for you. Now, please understand that anything which is to do with public markets, okay, you really cannot develop an unique access, because public market wrappers, be it alternatives or mutual funds, have infinite competition, and everyone has an access to it. That's why they're called public, and which is why it's very, very likely that you cannot build an excess advantage. Understand the excess meaning. Excess essentially means that you have something that people don't have. Your community doesn't have, and that actually becomes one very high operating leverage business. Because if, let's say, if Jio were to launch itself, an OTT platform, all that it has to do is to sort of telecast in India-Pakistan match once, which is not available anywhere else. That will do better than putting up, billboards across 700 cities in India, right? So because, people think that, that Jio has got a unique access to some match, and, so you don't have to advertise, and yet, there'll be millions of what do you call, app downloads. This happened with Geo. Same thing happens in almost all sorts of businesses. I'm sort of I come from a small town, Bhilwara, and a friend of mine sets up, these sort of small stores to sell groceries and stuff like that, but across cities in Rajasthan. And all he does is that, have natural ice cream, which is unique. In Rajasthan, you don't get natural ice cream, and that automatically improves the footfalls for him. So that's his excess strategy. I'm trying to sort of bring it adjacent to what you may think what excess is. I think, if you were to sort of think of your business and build a moat in it, you'll have to build excess, vis-a-vis advice and transaction. That sort of most probably will give a unique and competitive advantage to you. Okay, so now generally to build competitive advantage in your business, to summarize here, I think if you were to build an advice piece, transaction service, better, so I'm no one to advise you there. But if you were to build an advice piece, I think in advice you may want to build something else, right? I was just meeting a sort of gentleman outside. I said, कुछ और बेचते हो? तो बोले हम तो सिर्फ इक्विटी बेचते हैं और कुछ नहीं होता है, बट वो तो सभी इक्विटी बेचते हैं. See, please understand what is good, and simple. It's likely out of money. Okay, so in general, I think anyone who is actually selling public money wrappers, from mutual funds to anything, if it's an underlying product is public money, the terminal value of that business, I think, is zero. I think it's very likely that today or tomorrow or day after tomorrow, decent amount of tech would evolve and people will get educated to the extent that, you won't really need an intermediation layer. So my sense is that you will have to sort of open up your advice to something else, which is public, non-public together. So on the advice side, I also think that, outside of equity, bring something else, do fixed income, do private capital, do something else, for their client, so that your bouquet actually becomes bigger. Okay. Also, I worked with a firm and, we sort of kept calculating this, a large firm, Aditya Birla, and, we kept at a capital level, we thought that the incremental cost of actually acquiring a customer when you sell a new product to him, where you had already sold, let's say, insurance, was actually 80-85% lower. So that's sort of, again, an operating leverage bit, So my sense is that if you can sell something adjacent to what your client has already bought, most probably you would actually build more moat in your business in terms of higher ROEs, so to say. Again, as an analyst, I think I would appreciate your business more if your cost of actually acquiring a new customer is much lower, and which can happen when you can advise something else. So I think the most adjacent, no one wants to do fixed income right now. I can tell you that fixed income funds will be much larger funds in 10, 20, 25 years than equities. That has happened across the globe without an exception, including in US, which has got 100 years of history of great investing in equity. So please don't sort of ignore that. Second thing is, from an excess point of view, my advice will be that try and build an access to some form of private capital assets. I want to give you an example that, I was like, when I'm making this PPT last night, I was sort of searching up the top US AMCs, and I realized that of the top 25 AMCs in US, from AUM point of view, 22 are actually public money managers, the ones who manage S&P 500 centric or, money market centric funds. But if you were to look at US's top market cap companies, of those 25, only 2 are actually public market entities. One of them is Franklin. But otherwise, the top 10, 15, all names are actually private capital business. So if this audience was not you, but actually an AMC audience, and AMC CEOs were sitting, I would sort of nudge them that, pivot to private capital, because public capital business, the value is eroding. Franklin manages $1.5 trillion, and its total market cap is about $10-11 billion, lower than what HDFC Mutual Fund, even though HDFC Mutual Fund manages just about $50-100 billion. So that's the fate, even for an AMC. Forget about distribution. So my sense is that all the AMCs you will see will build a repertoire of actually building out something private, where, access becomes an advantage. It could do VC, it could do PE, it could do private debt, it could be anything. So my sense is that pivot away from public market, if you want to preserve the value of your business. Otherwise, let's say if you're doing an SIP business, okay, even though underlying markets are growing very fast, my general sense is that, I will not give you more than 10x of your next year's earning. But if you are doing a private capital business, my general sense is that, you will get about 50 to 100x right now, because the size is very small, but, is likely to grow sort of manyfold if what has happened in US. Okay. So now, get to within the private capital, I come here to sort of nudge you to look at private debt to begin with, because this is the first thing that we will be doing at Mosaic. I've set up a firm doing private debt, but my general view is that most adjacent to what you guys already know in fixed income, and relatively sort of a low cost, low frill affair is private debt. My sense is that this business, has grown, as Amisha also pointed out, sort of dramatically, even in India, but it right now remains just a family office business. My nudge to you and my belief that it is going to become a sort of as big a business perhaps as routine equity is in next 10, 15, 20 years. So, okay, in private debt, you will get confused with lots of definitions, okay, because we haven't yet sort of cracked the code. This industry hasn't cracked the code of simply saying mutual fund sahi hai or SIP sahi hai, So here, my point is that, when you look at lots of private debt alternatives, you sort of think of it, first principles again. As an analyst, you may want to think that, is it a diversified fund or a sectoral fund? Sectoral funds will be like, ones who are investing only in NBFC, only in real estate. Diversified will be the ones who will be investing all in. So if you're a first to credit fund or your client is first to credit, my preference will be to do diversified. For a family office, he's neutral to any category of fund. So that's one way to ask when you meet a private debt, manager, are you diversified or sectoral? The second, of course, is that, is he a performing? Meaning, is he investing in firms which are in good shape and are performing, versus the ones which are special situation, where some kind of special situation sort of has resulted in higher yield for them. So that's another way, that another filter that you may look at as private debt. And third thing is that, are these guys are making money from taking view on the firms that their credit worthiness will improve, or they are actually simply exploiting the regulatory cleavage. That there are many things in India or globally that banks and NBFCs aren't allowed to do. And only the funds can do that. And for that, because the large money of pool of banks and NBFCs is not available, which is why, funds are able to charge more. So that's a regulatory arbitrage business. So, in this sort of a basic first principle sense, you may want to differentiate the funds that you're taking. My advice is that if the first to credit guy, try and take a performing credit fund and a diversified one instead of a sectoral ones and the special situations one. So that's a basic framework I'm trying to tell you in terms of how you look at a lot of private credit funds. Finally, in asset management business, you will have values research, morning stars, and many star ratings available. In the private business, why access is become easy for, going to become a moat for you is precisely because information is an arbitrage here. In a sense, there is no sort of open architecture and information being made available to all the investors. So your job there is to sort of dig deep and figure out what exactly is appropriate for my investors, okay? And which is why, access to information, access to fund managers, and access to right funds actually become your moat, okay? So how do you then select if the value research and the morning stars and many other sort of star ratings are not available? The information with regards to performance is not available. I think the way to do will be these three things. One is that, of course, the talent and agency, which sort of applies to, so you invest in Prashant Jain's fund or that of some good fund manager's fund is essentially because you think he's talented, has experience, but also he has agency. Agency essentially means that whether there is enough skin in the game, of the fund manager or otherwise, so that becomes a very, very important filter to choose the right fund house. Second, of course, is that whether the fund house has the ability to diversify it and originate. Just a minute, I'm finishing, okay? And again, in public markets, आप button दबा करके you can buy Hindalco or ONGC or Reliance Industry. Here in private markets, why it is valuable is because access to good trade or good credits or good private equity itself is actually very, very difficult. Only few people in Bombay, Bangalore will have an access, or Delhi. Otherwise, no. Okay, you can't sit in Calcutta or somewhere else and think that, okay, let me start this business. You can do that as a PMS, investing underlying, public equities, but you really can't do. So you have to be sort of from that a small ecosystem, maybe only 500,000, 2,000 people sort of have that understanding and access to the kind of trades that, private debt business or private equity business can do. Okay. So again, origination skills and ability to diversify actually is very, very important. And the third metric that you will look at is that, you must ensure that there are no hidden costs, So I come from a mutual fund background, and, when we sort of set out to do the Mosaic Asset Management's first fund, my insistence was to sort of make the expenses low and sort of hyper clear, so that at least, people can compare us with, what mutual funds offer. But again, try and sort of ensure that you ask right and relevant questions from the fund managers or fund house, that what are all the costs. There are 20% yielding funds, most probably will deliver 12, 13 to the investors. Okay, our 16% yielding fund most probably will deliver 13, 14. So in a sense, low expenses are very, very important. So basically the transmission cost is that you must know for sure. So this is how kind of, how to select. Finally, with respect to the private credit business, I want to sort of make 2 points here, and I'll end here. 2 points here. Everyone thinks that, NPA, what if in a 16% yielding portfolio like that of ours, if let's say if I were to ask that if 16% of the portfolio were to go NPA, meaning non-performing, what will be the return? The first reflex of a guy is that the return will be zero. But you'll be surprised that, even then, returns most probably will be about 13%. So that is the idea of, building a very large protection in terms of higher yield, that even if, a large part of a portfolio goes down, ideally, a good fund manager should not have any delinquency or any NPA. But even if large part of a portfolio actually slips, then also it's almost very, very difficult, can't say impossible, for one to do inferior to a typical fixed income alternative, okay, which is fixed deposit or fixed income fund. So the only cost in these funds is that you must dial in right risk. And the cost here is mostly that, these are close-ended funds, your money is locked for 3, 4, 5 years, okay? 3 or 4 years actually, not even 5, in performing credit funds such as ours. So it's kind of think of them as FMPs, where a little bit of a downside protection is there, that you most probably on a base case will earn what you would earn in fixed deposit, but you will also earn about 5 to 7% excess if, if things do not go awry completely, okay? So very, very difficult that the impact of NPA in these funds would be as significant or any significant vis-a-vis a common perception is. The second part is that the impact of taxes. This basic perception that equity is a 12.5% capital gain tax, one, it's actually 14, 15 once you add surcharges. But also know this, that dividend is actually taxed at a marginal rate. So a blended rate for equity tax is going to be about 20%. Okay, especially given that 1/3 of the income of yours over the next 25 years will be made through dividend, okay, not capital gain. So you will end up paying about 20-21% taxes. So again, misconception that equities tax arbitrage relative to sort of debt. So you come to a performing credit fund, you most probably will pay 30%. Let's say you come through LLP, you come through company, you actually pay 25%. Equity, you will pay most likely about 20-21%. So the tax sort of shield available to equity is perceived to be much more than what it is in reality. Finally, my sense is that if you go to a typical fixed deposit or fixed income fund, you will most probably earn 4.5-5% net of tax. An arbitrage fund last 10 years has delivered about 5.5% gross. Most probably will deliver somewhere between 5% close to 5% of, net of taxes. Most probably equities, through the cycle will most likely deliver 9 to 11% of tax at current valuation, notwithstanding what Bharat Bhai said. I think it'll be more like 8 to 9% net of tax. I don't think in next decade in India, you're going to get more than 10% of gross yield from markets. And finally, I think a typical performing credit fund has a wide variety right now in the industry, but most likely will give you 8 to 10% of net of tax. So these are net of tax. I can actually dazzle you with 15, 16, 17% of yield that our fund will offer, but net of tax, it will be still very, very close to equity. So it sort of adds a little bit of an equity-like returns to you, but of a different kind of risk is how I kind of think that, performing credit funds could actually add value to your client. So please look at, so we run out of time. We have some flyers outside at Mosaic Asset Management's kiosk, pick up and sort of see if we can work together. In general, our hope is that, we, as an AMC, we've sort of good 8, 10, 12, CIO, CEOs have ganged up to set up this firm called Mosaic Asset Management. Our purpose is very different than 99% of the others. We want to do fixed income better. And so hopefully, we'll be able to add service and value to your clients. Thank you very much.